Crypto after the halving. Smart strategies while the market is still quiet. It is said that after the Bitcoin halving, there will be a bull run. Prices explode, altcoins join the party, and all portfolios are green. But in reality, it's June, and the market is still like a broken-down motorcycle. Bitcoin is rising, but not convincingly. Ethereum is flat. Altcoins. Many are like zombie projects. No ups, no downs, just mental torture. For many investors, especially those who just entered after the halving yesterday, this phase is frustrating. After all, didn't the halving trigger the bull run? Yes, it did, but that doesn't mean the next day the market went straight to the moon. What people often forget is, bull runs take time to mature. Like an oven, the halving is just a preheat button. Prices can consolidate for months before finally rising like crazy. The problem is, many people give up or get stuck prematurely. In this episode, we'll take a look. Why is it that after a halving, the market just doesn't work? What's really going on behind the scenes? And most importantly, what strategies make sense to do now, not later when everyone is already FOMO? If you're serious about understanding the direction of the crypto market, not just following the hype, you should definitely listen to this episode. Chapter 1. Halving is not an instant bull run button. First of all, let's get one thing straight. Bitcoin halving does have a strong history of triggering bull markets. But that doesn't mean the price goes up immediately after halving. Halving is just one of many factors that influence the price. Technically, halving does reduce the supply of new Bitcoins from 6.25 to 3,125 BTC per block. That means the selling pressure from miners is automatically reduced. But that's not a guarantee that the price will immediately fly. If we look back, it took months or even almost a year before the halving effect was really felt in the price. For example, 2012, first halving in November. The big bull market didn't start until April 2013, 5 months later. Second halving, July 2016. BTC started to rise significantly in early 2017, almost 6 months later. Third halving, May 2020. The price really exploded starting October, aka 5 months later. So if now in June 2025 the market is not hot, it is still in a historically reasonable scenario. The crypto market is like the weather cycle. There's a growing season, a rainy season, and a harvest season. And right now, we might be in transition between the growing season and the hot season. And yes, that transition is sometimes confusing. Now let's explore why the market could feel quiet post-halving 2024. The first factor, global macro conditions are still unstable. The Fed's interest rate has not risen again, but it has not dropped significantly either. Many institutional investors are still wait and see. This has not maximized the flow of large funds into crypto. The second factor, liquidity has not returned to full. Data from CoinMarketCap shows that global crypto daily trading volume had dropped dramatically to around $50 billion at the beginning of the year. And although it has risen again, it has not returned to the 2024 peak of $120 billion. The third factor, market capitalization is concentrated in Bitcoin. Bitcoin's dominance is currently at the level of 64% and even touched above 65%. This shows that investors tend to play it safe, diverting capital to the most fundamentally strong and liquid assets, namely BTC. This is like the phenomenon of flight to quality in the stock world, where investors pull funds from small stocks and move to blue chips when market conditions are uncertain. So if you feel that your altcoins are stagnant, yes, it does happen to almost everyone. The average altcoin, especially those with a small market cap, is still depressed. Many have not even recovered from the 2022 to 2023 decline. Data from Messari and CoinGecko shows that more than 70% of altcoins are still below 60% of their peak price. Meanwhile, BTC has recovered more than 85% from its previous ADH. This means that the market is being selective, and this is a feature of the market that is filtering out which projects are worth going up later, and which ones will be abandoned. The conclusion? Halving is a long-term trigger, not an instant catalyst. If you buy Bitcoin or an altcoin a week after the halving and expect the price to go up 100% immediately, then you are putting short-term expectations above long-term events. What's needed now is not aggressive speculation, but patience, cyclical understanding, and smart risk management. Because the reality is, When everyone gets bored and gives up, that's when the smart money starts accumulating. And when FOMO comes, they're ready to harvest. Chapter 2. Strategies for surviving the post-halving accumulation phase. Now we get to the important part, how to survive this tedious period. Many people think, if it's not a bull run yet, why stay? But these are the times that determine who is ready to harvest and who is just a spectator. The phase after the halving is not the time to guess at prices. This is the time to build a foundation. Because the majority of profits in crypto do not come from quick trades, but from consistency, research, and a disciplined accumulation strategy. First strategy, focus on allocation, not prediction. In the accumulation phase like now, don't waste energy guessing whether BTC will go up or down next week. What is more important is how you allocate your capital. The ideal composition for post-halving conditions like now could be like this: 50% in Bitcoin and Ethereum, 30% in stablecoins to maintain liquidity and be ready to buy the dip, 20% in selected altcoins that you really understand and believe in long term. Why is that? Because BTC and ETH still dominate around 70% of global market volume. Data from CoinGecko June 2025 states, Bitcoin accounts for about 52% of daily volume, Ethereum about 18%. The rest is just spread to thousands of other altcoins. If you put all your capital into small altcoins, you are swimming in a shallow pool. And if a whale jumps into that pool, it could drown. Second strategy, periodic accumulation with dollar cost averaging, DCA. Buy Bitcoin or Ethereum weekly or monthly for a fixed amount. The goal is not to find the lowest price, but to average healthy entries over the long term. Example, you have $1,000 allocated. Instead of entering all at once, you can buy $100 every week for 10 weeks. That way, you spread the risk and still have a bullet if the market corrects. And don't underestimate this simple strategy. Research from Fidelity Digital Assets shows that DCA into Bitcoin during the 2018 to 2020 bear market period provided 2 to 3 times higher returns than the initial one-time entry. Third strategy, use stablecoins actively, not passively. If you have a 30 to 40% stablecoin allocation, don't just sit on it. Use it for enter a safe DeFi pool, example, USDC/USDT on Aave, Compound, or Stargate. Keep it in CX with low-risk staking feature, or use it to catch the moment of correction of the altcoin of your choice. And remember, in the current environment, stablecoins are power because they give you flexibility. Veteran investors often say, the one who wins in the market is not the smartest, but the most prepared. And stablecoins equals preparedness. Fourth strategy, avoid the temptation of leverage and short-term trading. Yes, it does look tempting. If you can make 10x profit using margin, why accumulate slowly? But look at the data from CoinGlass. In the last 30 days, as of June 2025, more than 72% of short-term leverage positions were liquidated, with a total loss of more than $1.4 billion. Current market conditions are not suitable for margin play unless you are a professional. Volatility is low but can spike suddenly. Liquidity is not as thick as last year, and spreads on some altcoins are widening. Trading under these conditions is like riding a speeding motorcycle on a slippery road. It may be exciting, but the possibility of skidding is high. Fifth strategy, don't leave the market, even if you don't buy anything. Sometimes the best strategy is observation. Monitor on-chain movements. Check wallet whales. Pay attention to protocols whose developers are active even when it's quiet. Example, data from Glassnode shows that BTC wallets with balances above 10,000 coins are up 7% since January 2025. On the other hand, the transaction volume of small-cap altcoins dropped 40%, meaning that whales are more focused on BTC. Developer activity is still high in some ecosystems. Ethereum, Cosmos, and Chainlink are among the most active on GitHub over the past 3 months. So even though the price is sideways, innovation continues. And sometimes, those who survive the downturn get the earliest access to potential projects. In short, this post-halving phase is not the time to panic, nor is it a time to overtrade. This is the time to tidy up your portfolio, master the accumulation strategy, improve education, and stay connected to the ecosystem. Because if you can survive and grow in this seemingly crunchy time, You'll be much better prepared when the bull market does come. Not just ready to make money, but also ready to make decisions based on logic, not FOMO. Chapter 3. Distinguishing between accumulation and distribution, so you don't get tricked by sideways markets. Now we discuss one of the most classic traps in the crypto world. That is a price movement that looks flat, but turns out to be the Batman trap. Many think that the price is accumulating, even though it has entered the distribution phase. Or vice versa, a quiet market is thought to be dead, even though it is being secretly gathered by big players. The problem, on the chart, these two conditions are very similar. Flat, sideways, small volume. The candles are boring, but the impact is very different. If you misread it, you can buy at the peak price before the market dumps, or even run away from the market when the price is ready to fly. Accumulation versus distribution. What's the difference in market structure? First, let's talk about the simple definition. Accumulation, a phase where large investors, institutions, whales, buy secretly, usually after prices have been falling for a long time. The goal, buy a lot without making the price rise significantly. They are patient, entering slowly. The main signal, volume starts to rise when the price isn't going anywhere. Distribution, the opposite. This is the phase where big players slowly sell their assets to the market. It usually happens after a significant rise. The price appears to be stagnant, but the volume increases and then slowly decreases. The key difference, who is moving and where the money is going. Technical indicators that can help read the situation. 1. Volume plus price. During accumulation, volume slowly rises while price is sideways or trending down. During distribution, volume rises when the price is stagnant or rising slightly, but fails to break out. Example, look at the BTC chart for January-February 2023, accumulation phase. The volume gradually rises. Compare with April-May 2021 phase, distribution phase before the dump. The volume is high, but the price is stuck. 2. On-balance volume, OBV. This is an indicator that calculates accumulation/distribution based on volume. If the OBV rises while the price is sideways, it could be accumulation. If the OBV drops, but the price doesn't plummet, it could be distribution. 3. Open interest, OI, in derivatives. During accumulation, OI tends to stabilize or rise slowly. During distribution, OI can rise sharply, but is followed by massive liquidation. This is often a signal of a manipulative market, one that gives the stage first, then drops it. Check on-chain data. Who holds the goods? 1. Exchange reserves. If BTC and ETH are flowing out of the exchange, a signal of accumulation due to long-term storage. If a lot enters the exchange, potential distribution, ready to sell. Recent data, June 2025, from CryptoQuant. BTC outflow from exchanges increased by 11% in the last 30 days. ETH is also starting to exit CEX to self-custody wallets. This is a signal for accumulation. 2. Whale wallet activity. Look at wallets that hold greater than 1,000 BTC. If they increase their holdings, usually accumulation. If they send to exchanges, potential distribution. Data from Glassnode shows the number of whale wallets increased by 4% since the beginning of May 2025. But some of the older whales have also started splitting to smaller wallets. This could mean slow distribution. So mixed signals. Need to analyze more deeply. Market psychology. How retail makes the situation more obscure. Retail often falls victim to two major illusions. 1. Bullish illusion. Seeing the market go up a little, immediate FOMO, even though it could be part of a distribution designed to attract new buyers. 2. Bearish illusion. Market sideways, immediately panic and sell. But it could be an accumulation phase before a big surge. That's why understanding market structure is important. Because price movements aren't just about numbers. They're also about the intentions of major market participants. Real case. Altcoins that have cheated in the sideways phase. Example. $GLA in late 2021. For 6 weeks, the price was sideways in a tight range of 6 to 7 cents. Many thought it was a distribution because the price didn't increase significantly. But what happened? Volume slowly increased. Whale wallets increased. And boom, the price increased more than 10x in less than 2 months. In contrast, $LUNA before the crash in early 2022. Price looked stable in the $80 to $100 range. Volume was high, but exchange inflow increased. Whales started distributing tokens. And finally, well, we all know the story. Quick checklist: how to read market phases. If you want a quick check, here's how to read it. During the accumulation phase, volume usually rises slowly. The price tends to be sideways or rising slowly. OBV also goes up. Exchange reserves go down as people move assets to their wallets. Whales increase their holdings, and retail is hesitant to enter. But during the distribution phase, the pattern is reversed. High volume, but inconsistent, prices often fail to break out. OBV actually goes down. Many assets go to exchanges. Whales start to spread the goods. And retail is getting FOMO buying. If 4 or more of the indicators match on one side, that's most likely the phase that's happening. Don't be fooled by the quietness of the market. Sometimes when it's quietest, it's the busiest for those who know the game. Therefore, don't just look at the candles. Look at intentions. Look at the flow of money. Look at the data. And most importantly, stay patient. Because this game is not about who is fast, but who understands the direction before others realize it. Chapter 4. Never leave the space. Never leave the crypto market, even if it's quiet or boring. I know how it feels. When the crypto market is stagnant, prices aren't going anywhere, volume is quiet, and the media has started to rarely discuss it. It feels like everyone has moved on to something else. Telegram groups are quiet. Influencers only talk about giveaways. And our portfolio? Well, it's more like a comatose heart rate chart. But in this phase, the big players quietly start working. And those of us who survive can gain an edge that can't be bought in a bull market. Because history proves, crypto markets always reward those who don't get out of the ring. Let's break the reasoning into 2 parts. 1. Innovation never stops. And 2. Big accumulations happen when everyone else isn't looking. 1. Innovation never sleeps. Take a look back at history. Every bear market, it's not just the investors who survive. It's also the builders. Bear market 2018 to 2019. DeFi such as Uniswap, Aave, and Compound were born. All were built at a time when DeFi volume was almost zero. Bear market 2022 to 2023. Technology breakthroughs like real-world assets, RWA, narrative AI, modular blockchains like Celestia, and res-taking via eigenlayer. 2025. The big focus starts to shift to 2 important buzzwords: ZK rollups and DePIN, decentralized physical infrastructure networks. What are ZK rollups and why are they important? ZK rollups is a layer 2 technology that makes Ethereum transactions much cheaper and faster, but still secure. This technology will be the foundation for mass adoption. Projects like ZK Sync, Scroll, and Polygon ZKVM are quietly fighting behind the scenes to become major players. And second, DePIN. Imagine the combination of crypto and real-world infrastructure. Projects like Helium, Akash, and even small Pegasus like Demo and IO.net are all preparing the crypto meets physical world foundation. The business model is clear. Blockchain is not just for finance, but also for energy, storage, AI, and even internet bandwidth. So if we get out of the market now, we not only lose the price momentum, we lose the initial understanding of new trends that could be booming in the next 6 months or a year. 2. Big accumulations always happen in quiet times. Ever heard of the term smart money moves in silence? It's not just a saying, but the data really supports it. Data from Chainalysis and Glassnode, as of May 2025, shows something interesting. The number of wallets holding more than 10,000 BTC has increased by 8% since January 2025. Large addresses continue to add to their holdings, especially as retail volumes plummet. BTC reserves on exchanges continue to decline, meaning that more and more large investors are keeping their coins in cold wallets, aka they don't want to sell them anytime soon. But strangely, Google trends for the words crypto, Bitcoin, or altcoin are at a 3-year low. What does this mean? Whales and institutions are spending, while the public is moping. Retail FOMO hasn't kicked in yet, and that's a classic signal that accumulation is underway. 3. How can we survive and keep growing? Okay, we know that builders are still working hard, whales are accumulating, and new trends are being set. But if we just wait and daydream, there's no point. Here are some concrete steps you can take. A. Keep educating yourself. Read quality reports like Coinbase Institutional Weekly, Suw Crypto Theses, or Galaxy Research. There are many free webinars from Binance, CoinGecko, and even YouTube channels like Bankless and The Defiant. Use this time to learn more, from staking mechanisms, ZK technology, to DAO governance. B. Monitor on-chain data. Tools like Glassnode, Look into Bitcoin, CryptoQuant, and Dune Analytics can help us see what is not visible on the price chart. For example, exchange inflow/outflow volume, coin distribution to large wallets, and the number of new active addresses. C. Small experiments with low capital. Try DeFi or res-taking platforms like EigenLayer, Kerak, Renzo. Join testnets of new projects. Sometimes this can also be an airdrop farm. Use LSD, liquid staking derivatives, protocols like Lido or Ether.fi to understand how yield works while holding liquid assets. Don't get it wrong. Bear markets are not about instant gratification. It's about building edge, experience, and understanding the market. Those who stay understand the pattern. Those who pull out go back to FOMO and repeat old mistakes. You don't have to buy coins every day. You don't have to open the chart 24 hours. But never really leave this space. Because once you've completely lost touch with the market, it's much harder to come back. Forget the narrative, forget the fundamentals, and become part of the retail wave that comes late, again. The best investment in the crypto market is not just money. It's your time and attention. So don't just stand still. Stay curious, stay alert, and keep upgrading your skills and knowledge. The market will come back, and the most prepared, the most profitable. Ready to be a player who is not easily discouraged? If you're still listening to this, then you're not an ordinary player. You're not the type who only shows up when the market is green, then disappears when it's red. You're not just an impromptu money hunter, but someone who really wants to understand the game down to its roots. And believe it or not, that's already your biggest advantage right now. Because while others are waiting for the buy signal from YouTube or TikTok, you've already trained your own instincts. While others are still asking, what's a good coin? You already know the importance of narrative, on-chain data, and momentum accumulation. Remember this. The best players in crypto are not the smartest, but the most consistent. You don't have to be right all the time. You don't need to know all the technical stuff. But you do need one thing: to stay in this battlefield long enough for the rewards to come. And that reward isn't always in the form of money. Sometimes it's insight. Sometimes it's networking. Sometimes it's the right moment that can't be bought. So, after this episode is over, don't just be a spectator. Open up a new line of research. Join a small testnet. Study projects that are quiet but have potential. Don't wait for the bull market to come just to learn. Because once the market wakes up from its long sleep, those who stay awake will be pioneers, not followers. See you in the next episode. Important disclaimer before we close. This podcast is not a call to buy or sell crypto assets. All information is presented for education and perspective. Please always tailor your financial decisions to your individual risk profile. And don't forget, do your own research. DYLR, do your own research. Okay, before we end, don't forget our golden rules. 5 important rules of Mr. Suw Crypto. First, don't use hot money. Use only extra or idle money. Never use money meant for daily needs or urgent expenses. Protect your peace of mind. Second, don't over-leverage. Only risk what you can afford to lose. If you trade futures, always use a stop loss. The crypto market is fast, brutal, and doesn't forgive overconfidence. Third, 70% Bitcoin, 30% altcoins. Always allocate more to Bitcoin. It's the foundation of crypto. More BTC in your portfolio means better resilience during market crashes. Fourth, always stay in cash. Keep 10 to 20% in cash. This gives you buying power when the market dips and lets you take profit without panic. Fifth, think long-term. Investing is not a get-rich-quick game. Focus on long-term growth and protect your capital. Remember, even Warren Buffett didn't build his fortune overnight. If you find this video useful, help us grow by hitting subscribe and share it with someone who needs to hear this. Got questions or feedback? Drop it in the comments. Your voice helps shape this channel. See you in the next video, and don't forget, HODL knowledge and mindset first, then HODL assets.